Hi, welcome everybody. My name is Sarah Campbell. Thank you for joining us today to talk about the Employee Retention Tax Credit. We have Tim Larsen, who's going to be discussing this with us. Tim is a CPA and advisory partner here at Squire with over 40 years of experience in public accounting. Tim provides expert business operation and management consulting. If you take a look at the Q&A section, you'll see just a few little announcements with some links that might be useful to you. And please take note also that that is where you can submit questions. And I believe Tim will be answering those throughout. If not, it will be at least at the very end. So please feel free to submit any questions that you have through the Q&A. Tim, go ahead.
Thanks, everyone. It's good to be with you today. We're going to go over today the employee retention credit. And on the surface, this particular part of the law looks really simple, but when you get down inside, it is pretty complex. And so I hope that we have enough time to finish in the hour that we have. I'm going to try and get through all of my slides, but feel free to send in any questions. If we don't get to them during the presentation, we will certainly send out the answers to your questions afterwards. So let's get started. This is what we're going to cover today. So the employee retention credit was first enacted with the CARES Act back in 2020. So we're going to go through some of that, but there were changes to it twice, once in July of 2020, and then again in this most recent legislation in December of 2020. And so we're going to talk about what's new for the 2020 because it changed from what the original CARES Act was, what the eligibility requirements are. We're going to define what are qualified wages, and we're also going to look at how it interacts with the PPP loan forgiveness and other tax credits that are also available. And then we'll look at how it changes for the 2021 year. And there are some changes to eligibility. They're different than they are in 2020. There's also changes to the credit amount and the definition of qualified wages for 2021. And the interaction with PPP loans stays the same in both 2020 and 2021. And last of all, we'll talk about, well, how do I claim this credit? So this is just a brief summary. So in March, Congress passed, it might have been April, passed the CARES Act, which created the Employee Retention Credit. And then in July, they passed the Taxpayer Certainty and Disaster Relief Act, which enhanced and extended the credit. And then in December, as I said, Congress enacted the CCA. And this particular law allowed people to retroactively claim the Employee Retention Credit back in 2020. So if you haven't claimed it in 2020 and you're eligible, you can now do that. And it also made those people who applied for and received PPP loans, they can also receive employee retention credit. That was not allowable under the original CARES Act. So who is an eligible employer? So this credit is available to employers of any size, including tax-exempt organizations, but not government entities. You have to be engaged in a trade or business, and it's an employee-by-employee credit. So you have to calculate each employee's eligibility separately, but it includes wages in the calendar quarter in which business operations were either fully or partially suspended due to some government order or travel restriction that was due to COVID-19. Or if your business has suffered a 50% or more decline in gross receipts in a calendar quarter in 2020, as you compare that to the same quarter in 2019, and each successive quarter in 2020. So it's literally effective for second, third, and fourth quarters of 2020, and it remains in place until the first day of the first quarter, after which your gross receipts are now 80%, greater than 80% of what they were in that same quarter in 2019. So to kind of explain this, I've got some examples later on. There's also some aggregation rules. And so similar to the PPP loans, you have to define who the employer is. You have to aggregate certain groups. And typically it follows, and all members of the aggregated group are treated as a single employer for the aspects of the employee retention credit. So they follow section 52A and B of the Internal Revenue Code. And what that means is any parent subsidiary relationship is an aggregated group. So if you have an entity that owns other entities beneath it, they have to be rolled up and treated as one employer, or a brother-sister control group, which basically means if there is common control of 50% or more of any entity, so if the same person owns 50% or more of multiple businesses, then all those businesses have to be aggregated as one employer. And the only difference between A and B is A deals with corporations and B deals with partnership trusts, estates, and sole proprietors. Okay. Now, as I said earlier, if you are suspended either fully or partially, then you qualify for this credit. And this is the definition of some of those suspensions. So for partial suspension, you have to have been able to continue some but not all of your normal operations. And it's a supply concept, not a demand. So if it's whether or not you are able to supply the service or the product, not whether there's demand for your product. And if you're able to telework, then there is no suspension of any kind. And the operations must not be able to be continued in any manner that were comparable prior to COVID-19. Modifications to operations must have more than just a nominal impact on your business operations. And all members of an aggregated group are eligible employers even if only one member of that group meets the qualifications for suspension. So that's a pretty good thing. That makes a lot more wages eligible for the credit. So what's a government order? Well, it's any order from a city mayor that requires a business to close, and it has to be a non-essential business to close. State emergency proclamation that requires residents to shelter in place other than essential workers. And so if it's an essential worker, they can still qualify for this credit, even though they're not staying at home. The order from local officials that impose a curfew, and if that impacts your operating hours, then you still qualify for the credit. And if there's an order from a local health department that mandates that you close either fully or partially because you have required timings to clean and disinfect, then that is also a qualified government order. So I've got a couple of examples here. So the first one is a car dealership that's open for business, but its customers are under a stay-at-home order. This is an example of the supply issue versus the demand. So they're able to supply the service of selling cars just fine. It's just there's no demand because all of the potential customers are under a stay-at-home order. So this particular example, that car dealership does not qualify and is not considered to be full or partially suspended because they're able to open. It's just that the demand side is not able to participate in the service or product that they're offering. The second example is a restaurant. They closed their in-room dining due to a government order, but they are permitted to provide takeout or delivery service. In this particular example, they do qualify for a partial suspension of their operations because their in-room dining is closed, and that's a substantial deviation from what their normal operations are. And then the third example would be a brokerage firm that is a non-essential business. It's closed due to a government order, but all of the brokerage firm's employees are able to telework. And if that's the case, then they don't qualify for full or partial suspension because their business is able to continue even though it's slightly different because they're teleworking. This last example is a meat packing plant who normally operates on 3 shifts a day, but health officials required that they clean and disinfect at least twice a day or between shifts. And so that alters their operational cycle. And so they would qualify for a partial suspension of operations. And we'll talk about why that becomes important in some examples later on. Okay, the second way you can qualify for this employee retention credit has to do with how you were impacted in any quarter on your gross receipts in 2020 compared to the same quarter in 2019. So in order to qualify, you have to have had a 50% or more reduction in gross receipts in 2020 versus 2019. And that eligibility will continue, as we said earlier, for every quarter until the first day of the quarter following the quarter in which your gross receipts are back up to 80% or more of what they were in 2019. But the first part of the credit for 2020 only extends to January 1st of 2021. There is an expansion of the credit into 2021, but it's substantially different. And the other important note here is that this does not have to be related to COVID-19. If you just have a reduction because the economy has dipped, and that may be due or not due to COVID-19, and it's more than 50%, then you qualify for this employee retention credit. Okay, we need to define what gross receipts are, and they're different for a for-profit entity versus a not-for-profit entity. So the definition is that it includes total sales, less returns and allowances, but you do have to add back investment income, any interest, dividends, rents, royalties, or annuities, and the adjusted basis of any assets that may have been sold during that quarter. Not the total sales price, just the adjusted basis. You're able to subtract that out. That total sales price should be included in your total sales. For a nonprofit entity, it's basically the same, but there are a few more things that are included. So it's total sales, and then you add interest, dividends, rents, royalties, annuities, any contributions from donors, any gifts from donors, any grants, or any member dues have to be added to your gross receipts. And this pertains to all activities, not just those that qualify you for exempt status. So here's an example of a 2020 employee retention credit. So this is how you qualify. So if in the 4 quarters of 2019, your gross receipts totaled $200,000 in the first quarter, $250,000 in the second, $290,000 in the third, and $210,000 in the fourth. And then in 2020, you dropped to $180,000, $100,000, $140,000, and $180,000. You can see what the percentage, so this percentage represents the percentage that 2020 is of 2019. So in the first quarter, it's 90% or a 10% drop. In the second quarter, it's 40%, so a 60% drop. So that's the first quarter in which you would be eligible for the credit. Then in the third quarter, you're still at 48%, so you're below the 80, so you still qualify. And even if you'd have gone up to 52 or 56% or 60%, you would still qualify for that third quarter because you're not up to the 80% yet. And in the fourth quarter, you do reach 80% or more. You're eligible for that quarter, but it wouldn't continue into the first quarter of 2021. So that's how you measure eligibility based on gross receipts. Now, this next example is pretty similar. It's just that I forced it to show that in the third quarter, you were above 80%, and so you would be eligible for the second and third quarters, but not the first day of the fourth quarter because you exceeded 80% of your sales in 2020 compared to 19 in that third quarter. So you're eligible for the quarter in which you reach 80%, but you're ineligible the first day after that quarter. Okay, next definition that we have to explain is what are qualified wages. So qualified wages include gross wages that are subject to Social Security taxes and an allocation of that employee's allocation of healthcare benefits. So it includes a high deductible health plan, an HRA plan, or an FSA, a 125 cafeteria plan, but it does not include HSAs or QSE HRAs. So those are the things that can be included. So if someone exceeds the FICA limit, you can only include them up to the time that they start to have wages in excess of that FICA limit. The credit is 50% of qualified wages, and it's only for wages paid during what was considered the disaster time period, which for 2020 is March 13th through December 31st of 2020. It's limited to a maximum amount of wages of $10,000 per employee for the entire year. And so 50% of that 10,000 wages results in $5,000 per employee for the credit. Now, again, like I said earlier, this credit has to be calculated employee by employee. So the first step is to see if you're a qualifying entity, either because you're partially or fully shut down for a time period, or if your gross receipts have been reduced by 50% or more. And then you go to each employee to measure their eligibility based on qualified wages. So the other part of this law is that it only applies to employers that have under 100 employees. So if you have more than 100 employees, you still may be eligible if you were under government shutdown, but it will only be for certain wages. And so it will only, in the case of if you're over 100 employees, well, let me come back to that. So if you're under 100 employees, then everybody's wages count and all of their wages while you're under a government order, or you qualify for the decline in gross receipts. But you do not include any FFCRA sick pay. That's the COVID pay that you're allowed to get back from the government under this law that was passed in March, or the expanded FMLA. You can't double count the same wages for both credits. Now, if you're an employer that has more than 100 employees, you can only count wages while the employee is not performing services. So if you keep your employees or kept your employees during a shutdown and they were not working, then you can qualify even if you have more than 100 employees for those wages that were paid to those particular employees. You have to calculate how many full-time equivalents. So if you're less than 100, all wages count if you meet any of the criteria. But so you have to know what the rules are for calculating what is a full-time equivalent. And a full-time equivalent is anyone that worked at least 30 hours in a week or 130 hours in any month. And you calculate FTEs each month, add them all up, and then divide it by 12, and that will tell you what your average FTEs are. So if you're under 100 or 100 or less, then you qualify if you meet the other criteria. And again, the other criteria are being fully or partially shut down for a period of time, or if your gross receipts decline by 50% or more. So there's special rules that apply to businesses that were not in business in 2019. And if you're in that situation, you'll just need to call us. We're not going to cover those scenarios in this particular presentation. There's another caveat that if you have more than 100 employees and you lay off your employees, but you choose to continue to pay the employer's portion of their health insurance costs, then those become eligible wages. But you have to exclude those healthcare costs if there's a period of time that the employee did provide services, or if any amount of their pay is used and the employee covers a portion of their own health care, which most employers do have that in their pay plan. And the cost can be determined in several different ways. So if you have a large plan, you may determine the cost by actuarial calculation, or you can do it based on simply the premiums that are paid by both the employer and the employee. Again, this only applies to furloughed employees where the employee is not providing services, but the employer chooses to continue to pay their health insurance. And the allocation method, you can use any reasonable method to arrive at the portion that pertains to any particular employee. Okay, there's a few things that are not counted as qualified wages for large employers, and those are any PTO that the employee might have accrued, any severance or post-termination payments that are made, and again, any wages that are paid under the FFCRA, sick pay or expanded FMLA, or any wages that were used for the work opportunity tax credit or paid family medical leave that was taken. And it does not include any employer payroll taxes. There's a lot of confusion in some people's minds. The PPP allowed you to count certain employer taxes, and there's also on the sick pay, you can claim some of those employer taxes for reimbursement, but for the employee retention credit, you can't count any employer paid payroll taxes. The other caveat is that you have to use, it's a look back period. So the rate upon which you calculate the employee retention credit is the 30 days immediately preceding either the suspension of services or when you achieve significant decline in gross receipts. So for example, if the first quarter or the second quarter of 2020, you were 50% below on your gross receipts, you would have to use the 30 days immediately preceding April 1st as the rate upon which to calculate the employee retention credit. Okay, some examples here. So this is a restaurant. They have less than 100 full-time equivalents in 2019. And for purposes of this example, we're just going to assume that all their wages are considered to be qualified. Their business operations were partially suspended due to a government order between April 6th of 2020 and May 31st. They are allowed to do takeout services, but the restaurant chooses to only pay their employees 60% of their normal wages. But the restaurant is paying whatever they paid prior, 100% of whatever their health premiums were prior. And for the example, I used 150 per week per employee. So here's how you calculate the employee retention credit for this particular scenario. So Chris, who's working, he gets paid $1,500 a week. So there's 8 weeks in my example. So 1,500 times 8 is $12,000. The employer's chosen to only pay them 60% of their otherwise eligible wage. So that calculates out to be $7,200. But they are paying the $150 a week for health care. You then add those two together, the $7,200 and the $1,200. So the eligible wage for this particular employee, Chris, is $8,400. And the rate of the credit is 50%. So for Chris, the credit would be $4,200. Deb, who is not working, earns $2,000 normally per week. And so 8 weeks of that is $16,000. 60% is $96,000. They get the same insurance add back or add to. So their qualified wages and health insurance is $10,800, but you're limited to $10,000 per year in 2020, and so that's the maximum you can calculate the credit on. So that particular employee would receive a $5,000 credit. So in my example, the total credits would be $9,200. In the second example, pretty much the same set of circumstances. So less than 100 full-time equivalents, still a restaurant. All wages are considered to be qualified. The restaurant has 60% decline in gross revenues for quarter 2 of 2020 as compared to quarter 2 of 2019. but the restaurant only has 15% decline in Q3. So that would mean they're eligible based upon reduction in gross receipts for Q2 and Q3, but they would not be eligible the first day of Q4. So again, the employer pays 60% of their wages in Q2, but they pay 100% of the health premiums per week in this particular example. So, and I'm assuming in both these examples that the restaurant only has 2 employees, just for simplicity purposes. So here's the calculations. So Jeff, who's working $500 per week, we take 60% of those 13 weeks times, or it's 500 times 13 times 60% is 3,900. The employer pays their 100% of his wages though, and because he's working, and so that's $6,500. And the health insurance works out to be $3,900. That's 150 times 26, and so we add those together. That's 14,300. Again, the limit for the year is 10,000. So the maximum credit for Jeff is 5,000. And similar with Amy, just with larger numbers, and so that she's limited to $5,000 credit as well. Now a third example. So this is one, I'm using this example because this is one, rather than having a reduction in employee or in gross receipts, they're partially suspended. And so they were suspended from April 6th through May 31, but they have takeout service and similar circumstances, similar numbers for the example otherwise. So here's how this one would work. So Deb, whose wages during that period of time from April 6th to May 31st is 40,000, and the employee's working is 60% of that, so that's what the employer has chosen to pay, but they pay 40% if you're not working. So in this particular case, Deb is not working, so she gets paid 40% of her normal wage for not working, which is $16,000. And 40% of the healthcare insurance, and you'll have to just do the math to see that I got the right answer. You add those two together, but again, you're limited to $10,000 of wages and a $5,000 credit. So in this next case, if Jeff is working, he gets $14,400. If he's not working, they're only paying 40%, so $9,600. And that's the employer's choice, by the way. This isn't a part of the law. The employer could be paying them 100% of their wages. Just in my example, they're only paying them 60% if they are actually on the job and 40% of their normal wages if they are not working. But in each of these cases, you can see that their wages, their qualifying wages and health insurance exceed the $10,000 per year limit. So they're limited to $5,000 credit on those 2 employees. All right, let's talk about the interaction between the employee retention credit and PPP loan forgiveness. So as I said earlier, wages cannot be used for both PPP loan forgiveness and the employee retention credit. But often, and we found this in our office as well, that we didn't know that this law was going to change. We didn't know that those who had applied for PPP loans would ever be eligible for the employee retention credit. The banks were eager to get applications for forgiveness processed, and so it was easier for them if we just used wages, and if the wages were enough to qualify for full forgiveness, we didn't report or didn't help clients report any other expenses. So on the timeline, but let's just say this is company B. So if their loan period was from April 22nd to October 6th, there's some question about whether you may be able to only count enough of the wages for PPP loan forgiveness to get 100% qualified, or you may add in some of the other costs, and I'll show you that later on in some examples. But in this particular case, even if they were disqualified for all of the PPP loan covered period from April 22nd to October 6th, they would qualify for the ERC if they met all the other qualifications from March 13th, which is when this all begins, until the first day before their covered period, and then again the first day of after their covered period to December 31. So that's all I'm trying to show here, is that you can do both. You can qualify for both, but you can't count the same wages for both. So I put together a couple of different situations, and the American Institute of CPAs, which is what the AICPA stands for, they have recommended to the IRS and to Treasury certain outcomes. And I took both of these examples that I'm going to show you from their examples in the letter that they wrote to Treasury. So an employer received $1 million PPP loan, but they reported $1.5 million of payroll costs for their covered period, and the entire loan was forgiven. So the question is, would they be permitted to use that extra $500,000 of wages that were on their loan application for forgiveness that were in excess of what was needed for forgiveness? And the AICPA is recommending to the IRS and Treasury that the answer to that question be yes. We don't have official guidance yet, but we are hoping that Treasury and the IRS will agree with the recommendation that's being made. And so we'll have to keep you informed as to what the outcome of this will be at a later date. Watch our website, check back with us, call us, whatever. We will be watching this closely, but we don't have a determination exactly. If the answer is no, you would still qualify for the employee retention credit from those dates that I showed you on the prior slide. The second example is similar. So there was $1 million loan that was granted. The company reported $1.5 million of payroll costs for their covered period, which covered their loan forgiveness, obviously, but they also incurred $100,000 of rent expenses in the covered period, but they did not report them on their application for forgiveness, and the entire loan was forgiven. So the question is, would they be able to count both the $500,000 of excess wages beyond those needed for forgiveness, and could they replace $100,000 of those wages with the rent for purposes of forgiveness, so they would be able to claim $600,000 of wages for the employee retention credit? And again, the AICPA is recommending that the answer to this question be yes, but we still don't have an answer on this particular question either. So we'll just have to wait and see. Okay, so that's the rules for 2020 credits. Now we're going to transition and talk about how that changes when we get to 2021. And so some things are common to both 2020 and 2021, and some things are unique. So in the PP loan borrowers being able to claim the credit covers both periods, both 2020 and 2021. But in 2021, public colleges, universities, public healthcare entities can claim the employee retention credit. And the credit is extended beyond December 31, so it covers the first 2 quarters of 2021. And it may likely be extended beyond there. There will be some additional stimulus legislation that will take place here in the next few months. We don't know what that will be, but this credit is one that likely could be extended. For right now, it only extends through wages paid through June 30th of 2021. One big change is that the qualified wages per employee are increased from $10,000 per year to $10,000 per quarter. And it eliminates the 30-day look-back period that may limit some of the qualified wages. Another really good change is that the credit calculations is increased from 50% of qualified wages to 70% of qualified wages. And the significant decline in gross receipts only has to be 20% versus 50% to be eligible for the 2020 credit. Now you compare 2021 drop to 2019, so pre-COVID amounts. That's what you're comparing. And you can make a special election to just use fourth quarter of 2020 to determine eligibility for all of 2021. If you have questions about that, let us know. It is a little bit simpler. Another change is that employers of 500 employees or less qualify for the 2021 credit. And you still qualify if you've got more than 500 employees if you're paying employees who are not rendering services. And remember, back on the 2021 credit, that number of employees was only 100. And again, there's special rules if you were not in business in 2019. Again, just call us if you're in that situation, because there are special rules. They're slightly complex, but we'll help you get through that. And you can qualify for an advance payment on the credit if you're less than 500 employees in 2021. Okay, so in trying to explain this, I'm going to break it up and say, here's what it was in 2020, here's what it is in 2021. So you're eligible for the credit in 2020 for any employer size, given certain situations, but tax-exempt organizations are included in 2020, but not government employees. But some government employees are included in 2021, namely those being colleges, universities, hospitals, medical care facilities that are government owned. And in 2020, any entity, this is pre-CCC law, so pre-December 27th law, any entity that received a PPP loan was not allowed to claim the ERC, but now you can claim it in 2020 and 2021, but you can't count the wages for both the loan forgiveness or any other credit that is available. The gross receipts test, it was 50% drop for 2020, only 20% in 2021. So more people are going to be able to qualify. And again, in 2020, you compare a 2020 calendar quarter to the same quarter in 2019. For 2021, you compare the quarter in 2021 to the same quarter in 2019, or you can use that fourth quarter exception. If you meet it for fourth quarter, then you're eligible for all of 2021. The other changes are that you're limited to $10,000 annually in 2020, $10,000 per quarter in 2021, fewer than 100 employees in 2020, fewer than 500 employees in 2021. And it's similar for those that are greater than those limits, but you're paying people who are not rendering services. The rate in 2020 is 50% of qualified wages. The rate in 2021 is 70% of qualified wages. Okay, let's look at some of those same examples. So this example is an employer, a restaurant, that has less than 500 full-time equivalents in 2019, and all of their wages are considered qualified wages. By the way, if I didn't point out before, the FTE calculation is based on 2019. If you're higher than that in 2020 or 2021, you still are eligible as long as you meet the FTE requirements with your 2019 employees. So the business operations have been partially suspended, but they do have takeout services. The restaurant's chosen to pay their employees 100% of their normal wages, and they're also paying $150 per week per employee for health insurance. So here's how this works out. So in Q1, Chris makes $7,000, and he gets $150 per week for health insurance for those 13 weeks. So his qualified wages and health insurance is $89.50. He's limited to that amount, but he gets a 70% credit. So his credit is $6,265. Deb, on the other hand, makes $15,000 in Q1, plus her $19.50 in health insurance, for a total of $16,950. She's limited to $10,000 for that quarter, and so her credit is $7,000 for a total of $13,265. In Q2, Chris makes $16,000. Now he can't take any portion of the Q2 wages back and claim any unclaimed credit on the Q1. So this is not only an employee by employee calculation, it's also a quarter by quarter calculation. So in this example, he's limited to $10,000 in Q2 of qualified wages, so his credit is $7,000. Deb, on the other hand, because she's under the $10,000 in that quarter, she can't carry over any of her unused from the first quarter, but she can claim 70% of her qualified wages in Q2 for $5,565 for a total of $12,565. Okay, last of all, we'll talk about, now that I've got, and these are difficult calculations, by the way. It's employee by employee. And first of all, you measure eligibility either by being partially or fully shut down, or in 2020, your gross receipts were reduced by 50% or more, and in 2021 by 20% or more. Once you've determined eligibility, then you look at each employee and see if they are eligible, and you do the calculation employee by employee and quarter by quarter. So these credits are claimed by reducing your payroll tax deposit. Or if you didn't do it in 2020 in the quarter where the wages or the qualified wages occurred, you can amend your 941 and get a refund of these credits. But if you were applying for a current quarter, let's say you know that you qualify for the employee retention credit right now, and you've got a payroll that's due tomorrow, and your payroll taxes are $15,000, you can reduce that by all of the $15,000 up to the amount of your credit, and just keep that money rather than send it to the government for your payroll tax deposit. So it's an immediate credit, and you will claim that on 941. You can reduce your deposit now, but when you file your first quarter 941, you'll report all of the amounts that you did not send to the government that qualified for the credit. If your credit exceeds the amount of your deposit, you can file Form 7200, which will give you an immediate refund of any excess. They are limiting that you can't file for any refunds unless they are over $25 in amount. And again, you'll true everything up on Form 941. Now, I don't know how easy this is going to be to see. It's pretty small print, and I realize that. But this 941 form, as you probably know, was revised in July of 2020. It was revised to handle both the FFCRA credits for sick pay and expanded FMLA, but it was also revised to handle the employee retention credit. So the sick pay credits go on the first page. They actually, you put in the amount of qualified leave wages or sick pay leave wages right up here in lines 5B. Well, it's 5A1 and 5A2. And then you continue with the calculation for the rest of your 941. The employee retention credits are entered on line 13D of page 2. So you have to do these calculations outside of the 941, determine their amount, and then you enter it here. Now you're going to be doing it payroll by payroll if you're doing it for 2021. And so you'll just have to track what you reduced your deposits by and perform your calculations and then enter those in here. Remember, it's qualified wages plus the allocable portion of health insurance. There's a worksheet that is on the very last page of the instructions for Form 941 that will walk you through the calculation. I don't think it does a very good job, but and namely because they're asking you to do it in total rather than by employee, rather than employee by employee. I have built an Excel spreadsheet that I'm willing to share with anyone if you would be interested, that will do the calculations for the credit both in 2020 and in 2021. So just put your name in the chat and an email address, and I'll be happy to send you the Excel spreadsheet that I developed. And again, once you get those totals, there's no need to fill out this worksheet because you'll already have your credit amount that can just go onto line 13D of page 2 of the 941. This is just a picture of the 7200 form. It's a special form that was created in July of 2020 and then revised again in January of 2021. And again, this form is used if your credits exceed the amount of your current deposit. And so in my example, total deposit that you're planning to make is $15,000, but I've got employee retention credits of 24. You would use this form to get a quick refund on the $9,000 difference. And again, it will all be reconciled when you file your 941 for the quarter. So I just wanted to retouch on some of the interplay with other provisions. So remember that you cannot claim the same wages for the PPP loan forgiveness or for any of the FRCA sick pay and medical leave credits or the employee retention credit. You only get to use those wages once. And there's an optimal order for the way that you should do this. So sick pay and medical leave credits are not available to be counted for the PPP loan either. And so you should use those first. Then you should use what's necessary for your PPP loan forgiveness. And I would maximize the amount of other expenses that you incur if you qualify for the employee retention credit also, because that will free those wages up to be used for the retention credit. So that's the optimum order. I think that applies most of the time. It may not apply to 100% of the situations, but I think it will apply most of the time. If you have not applied for forgiveness of your first PPP loan, then you probably should contact us and we could help analyze to see whether you qualify for any of the sick pay or medical leave credits, whether you qualify for or what you should use for your application for your PPP loan forgiveness, and then we can also assess whether you qualify for any of the employee retention credits. One of the things that we found is that many people were not aware of the FFCRA sick pay and medical leave credits. If you did not claim those in either the second, third, or fourth quarters of 2020, then you can still go back and amend your 941s and claim those. Those credits are actually mandated for certain number of employees. I think, Megan, you might remember this, but I think if you're under 500 employees, you were mandated to continue to pay people who were either sick with COVID-19, quarantined because they'd been exposed, or if they were home caring for minor children, or that were out of school, or that their daycare facility was closed down, or caring for someone that had COVID-19. So those are paid for by the government. And if you haven't applied for them, we would recommend that you analyze that and go back and claim those credits. They're substantial credits. Then also analyze to see how you apply for a PPP loan and what expenses you use. And then thirdly, see if you qualify for either partial or full shutdown and or the reduction in gross receipts, either for 2020 or 2021. Okay, I'm out of breath and my throat's dry, but I'm happy to answer any questions that you might have.
Tim, this is Megan. I do have a few questions. We'll see if any more come through the chat. But one quick question is, how immediate is that 7,200 form refund?
It's not going to be overnight, but the IRS has said that it will be expedited. Their goal is to get that turned around in 10 days.
Okay, great. And then 2 questions on the gross receipts for those who would qualify with reduction in gross receipts. So one is, you mentioned, you know, if Q2 was below 50%, and then Q3 you had, you know, over the 83, that would mean that Q4 would not qualify you anymore. But what if Q4 reduces again? Like what about that roller coaster situation, especially for those who are seasonal?
Yeah, you would qualify again. So if you had, say you're greater than 50% reduction in Q2, only 10% reduction in Q3. So you're still eligible for Q3 because you were eligible in Q2. But now you'd measure, if you wouldn't be ineligible for Q4 if your gross receipts were still less than 50% of what they were in 2019.
Okay, great.
And that rule, that 80% rule doesn't apply to 2021 gross receipts, the 20% reduction. You just measure that quarter by quarter. There's no disallowance if you go back up in 2021. You measure each quarter on its own. So if you're eligible in Q1, great. If you're eligible in Q2, great. But you have to look at each quarter. There's no carryover like there is on the 2020 credit.
Okay. And then in your gross receipts list of all the things in a for-profit entity, there was a line that said that you could subtract out the basis of the assets that were sold.
Yes.
And I wondered if that was specific to if you like bought or sold some capital assets, or does that include inventory?
It does not include inventory. It is capital assets.
Okay.
So what it's really doing is you only have to count the gain. So you report the gross amount, but you count the basis. So you're really only reporting the gain in your calculation.
Okay, that's what I expected. I just wanted to make sure that what you just said is consistent with other measurements that for gross receipts. So I just want to make sure there wasn't a big difference there.
I kind of messed that up as I was explaining it. I didn't do a good job there.
No, you're fine. I have not seen any other questions coming through the Q&A, and so I don't have any other questions that I took note of. So I think
Megan, I'd just like to reiterate that every business ought to go back and look to see if they continued to pay people who were not at work because they were sick, or because they were quarantined, or because they were caring for somebody who was either quarantined, sick, or a minor who needed care and their school was closed or their daycare facility was closed. If you continued to pay people, you not only qualify, but it was a mandate to continue to pay people, and the government was willing to pay the wages and the payroll taxes and the healthcare costs. And so you ought to go back and reconsider that if you did not take advantage of that, because it would be money back in the pocket of your business. So
and on that note, that same credit is available for 2021 as well. It is optional, You aren't required to pay people, but if you do choose to pay them, you can get fully refunded through payroll taxes. And so there is incentive for you to do that so that you can pass that benefit on to your employees who are hurting because they're out of work.
And I would say too that, well, if you need to go back and amend 2020 941 reports to claim this, the statute of limitations is 3 years. So for the second quarter, you would be able to amend that until July 31st of 2024, right? No, 2023 for 2020. So it's not urgent, but I still would do it while things are fresh, because there is some documentation required on documenting why they were out. Why was the employee out? Were they sick? And things like you could get a note from their doctor, or they could give you a written statement that they had been exposed and so they were home quarantining. And again, this is even if they can work from, well, I don't believe they're eligible if they can work from home, right, Megan?
Right.
They
It's just a replacement for work that they were unable to do.
Yeah.
We have a few questions are coming in. So we have a question. The credit we're talking about, this medical leave credit, is for only for 80 hours, correct? And is that reset? I know it reset for 2021, but is that a per quarter reset?
No, it's a maximum per year, but it's still a pretty substantial amount of money.
Yeah.
If it's the employee that's home, it's $500 per day, or it's per day, $500 per day, up to, it's the regular pay up to $500 per day, which I think calculates out to be $10,000 total. And that, again, that includes their employer payroll taxes plus their health care costs. So you would add all that together to test to see if you were in excess of $500 per day.
Yeah, so you'd be able to do that for the year 2020, and then again another 80 hours for the year 2021. And this currently is also set to expire June 30th of 2021.
Yeah. We probably have more people actually out right now with actual people who have contracted the virus than we did in the summertime or early fall, because our counts are so much higher.
Yep. Okay. We don't have any other questions. Thank you, Tim.
Well, I was surprised I made it through all of those. I thought I would end up going over, so I'm glad I made it through. And I saw a question that said, will the recording be available? And yes, it will be. We'll send that out to everyone. And if you have questions, don't hesitate to call us. We'll be more than happy to help you. Thank you.